Stock's going to fade or stock's going to rip? We got 10 minutes to find out. Let's pass the time by talking some bonds and get back into the main theme of the day. Collin Martin joins us, Director and Fixed Income Strategist at the Schwab Center for Financial Research. You know, it's a big macro Fed bond day, Collin, but the bond market's pretty quiet. What do you make of this bounce in treasuries?
Yeah, we saw yields decline after the meeting, even though the meeting was generally as expected, where the Fed held rates steady. That was widely expected. If you look just at the median dots, now there was some dispersion here and there, but the median dots didn't change either. But we saw yields fall, and I think that had to do with the updated economic projections, specifically as it relates to GDP. We saw some relatively big downward revisions to GDP for not just 2025, but also 2026 and 2027, with the median projection looking for GDP to come in below 2% each of the next 3 years. So I think that's been a key driver. So even though we kind of got a balance of slower growth, higher inflation, not much change to the unemployment rate, I think the markets were looking more at that decline or downward revision to GDP, because if the economy does slow, given all the uncertainties we see right now, maybe that's what will pull yields or the Fed funds rate a little bit lower than we're expecting right now.
Okay, so then we get bonds firming a little. Interesting that the dollar is up too in the mix. We were kind of puzzling over that. I wanted to get your thoughts too, as I know you cover the dollar and your role.
Yeah, I'm a little puzzled by that as well. What we've seen over the past few weeks and months is, interest rate differentials look like they've been driving the dollar and currencies market for a little bit, and where we've seen yields come down in the U.S. and we've seen some global yields increase, we've seen that dollar weaken. Today, we actually didn't see that happen, where we saw the decline in treasury yields that I just alluded to, and then the dollar rise a little bit. I mean, the move was relatively minor. I don't have too much insights there. I think there's so many moving parts right now. Even when you look at the stock market, I'm not a stock guy, but if the markets for treasuries are really pricing in that slower economic growth, that doesn't really jive with the upward move in stock. So I think there's a lot of movement right now. I think the key takeaway is uncertainty. And Fed Chair Powell mentioned that. I mean, the statement highlighted that uncertainty has increased. And then even in his press conference, Powell mentioned that we should he insinuated that we should take the projections with a grain of salt, because if there is this uncertain outlook right now, when they're putting their projections out there, be it economic, be it inflation, or be it their dots, that can change given how much the outlook is uncertain right now.
Okay. And how much do you think they, similar to a question I asked Dennis Lockhart earlier about flexibility, it seems they're pretty flexible on rates as we see, but in terms of the balance sheet, slowing the runoff, one of my very popular guests, Cem Carson, was making the call, I think it was last month, that the Fed's going to be doing QE by the end of the year. What path do you see them going as far as the monetary side goes?
Yeah, we're not expecting QE by the end of the year, but the QT, I think that did surprise the markets a little bit. We've been looking at the potential for the Fed to end QT outright sometime soon, not necessarily at this meeting. And they clearly didn't do that, where they lowered the cap on maturing treasuries down to $5 billion. That kind of gives them optionality, where if they were to eliminate the treasury runoff altogether, then it's more of a headline if they decided to turn it on again. So keeping it at $5 billion per month allows them to keep it going, takes less money out of the economy, and then they can kind of tweak it as they can going forward. So I don't know if this is necessarily the end of QT. They're going to continue with their mortgage-backed securities rolling off. I think they still want an all treasury balance sheet, but we don't think it's the end. But to your point before, Oliver, we're not expecting QE by the end of the year, because that wouldn't tie in with our outlook for the Fed funds rate either. I think to get QE, you'd need to see the Fed cutting for really nefarious reasons. And right now, policy appears to be in pretty good shape. Fed Chair Powell talked about that. They have time. Time is on their side to hold steady for a little bit, see how all the uncertainty from the potential policies play out, and then maybe cut one or two more times later this year.
Okay. So you're thinking that 2 is kind of the sweet spot, it seems like right now. What do you think would change that outcome. Obviously, he's watching jobs, but so far it looks like it's not registering anything negative in his mind. He talked about the long line for jobs, but no real major layoffs. Is that lining up with the data you see in terms of credit, in terms of signals on the health of the economy?
Yeah, we know they'll be looking at the labor market. He highlighted a bunch of the things they're looking at in terms of the quits rate and the hiring rate and how they've kind of come into balance. So different things other than just that headline unemployment rate or that the markets tend to focus on. But I think that is what they'll be zeroing in on. If we see a significant weakness in the labor market, that's something that could drive more cuts than expected. But as it stands now, here in March of 2025, we're thinking one or two cuts, maybe just one right now. One key takeaway from the meeting and specifically the updated projections is the dispersion of the dots. Because if you look at a headline or just what that median dot suggests, it's unchanged from the December meeting. So the median dot still implies two cuts this year, but the dispersion changed a lot. We basically got a reset higher pretty much across the board where, fewer participants are expecting more cuts and more participants are expecting fewer cuts. I think that made sense what I just said. But just the way the math works, the way the median is calculated, it didn't change. Now the average probably changed,
Right.
but the median didn't. So there's a growing chorus of participants who are probably leaning more towards one or zero hikes rather than the two that the headline would suggest. So as it stands now, if nothing changes, we're probably looking like closer to one cut.
Okay. Like the statistics in there, quick on the feet. Appreciate that. Thanks, Collin Martin.